There's a financial vehicle that lets an ordinary person build a private, tax-free banking system inside a life insurance policy, completely legally. And every major bank in America quietly holds billions of dollars in it on their own balance sheets while your financial advisor tells you it isn't worth your time. Most people get the same script. Buy term insurance. Invest the difference in the market. That's what the calculators show. That's what the personal finance blogs repeat. And if you follow that advice, you'll spend your entire wealth-building life exposed, every market crash hitting your portfolio, every withdrawal creating a tax event, every emergency raiding the same account you've spent decades growing. You're told this is just how wealth works. It isn't. The wealthy figured out a different system a long time ago. You just weren't invited to that conversation. The strategy is called infinite banking, and it runs through something called a dividend-paying whole life insurance policy. Stop. I already know what you're thinking. Life insurance is the wealth strategy. Stay with me. Because what most people picture when they hear whole life is an expensive, slow policy a pushy agent sold their parents. That's not what this is. A properly structured whole life policy, one built to maximize cash value, not the death benefit, functions like a private bank account you control. Every dollar you put in grows at a guaranteed rate, tax-deferred. The cash value accumulates year after year. And unlike a 401k, there are no contribution limits, no age restrictions, and no IRS strings attached to how you access the money. None. Here's the mechanic. You pay premiums into a whole life policy. A portion covers the insurance cost. The rest pours into cash value. That cash value grows every single year, guaranteed, plus dividends if you're with a mutual insurance company. Those dividends are not taxed as ordinary income. The cash value is liquid. You can borrow against it anytime, for any reason, with no credit check, no approval delay, no taxable event. Policy loan rates run low, typically 5 to 6%, and here's the part that breaks the brain. While you borrow against it, your full cash value keeps compounding as if the money never left. You're using the same dollar twice. Say you've built $200,000 in cash value. You borrow $80,000 to fund a rental property purchase. Your full $200,000 is still earning dividends inside the policy. The rental generates income. You repay the loan on your own schedule, no penalty for slow repayment, no bank calling the note. And when you die, the entire death benefit transfers to your heirs income tax-free. A family holding a $2 million policy passes $2 million. No probate, no income tax event. The IRS gets nothing. It clears in weeks, not years. But here's where it gets interesting. The largest holders of whole life insurance in the United States are not individuals. They're banks. Bank of America, Wells Fargo, J.P. Morgan Chase. They hold hundreds of billions of dollars in what's called bank-owned life insurance, BOLI, because they understand it's one of the most efficient stores of tax-advantaged capital that exists. And the wealthy figured it out too. Walt Disney borrowed against his whole life policy when banks turned him down for the capital to build Disneyland. J.C. Penney did it. Ray Kroc did it. This doesn't show up in school curricula because there's no product to sell you afterward. No management fee. No annual percentage skimmed. No advisor collecting a trail commission every year you hold it. The people who profit from your financial ignorance have no margin in telling you the truth. Now here's the honest part. This strategy takes patience. Cash value builds slowly in the early years. The policy is front-loaded with costs, and if you surrender it in year 2 or 3, you lose money. It also demands the right policy design, overfunded, low death benefit, high paid-up additions rider. A badly structured whole life policy is exactly as expensive and useless as your advisor described. A properly structured one is a different animal entirely. And the IRS has sanctioned this strategy in the tax code since 1984. Section 7702. That's not a loophole. That's a feature written into law. So the question is never whether this works. Banks use it. The code protects it. The math holds. The question is why nobody told you. The financial industry profits every year your money sits exposed under their management, subject to their fees, taxed at withdrawal. A private banking system built inside a whole life policy moves you outside that game entirely. And once you understand the game, you start to wonder what else they left out of the curriculum. There's a related move that takes this further. A specific trust structure, the ultra-wealthy layer on top of this to pass capital across multiple generations completely tax-free. That's the next file.